Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Kieran Kerwin, Director, Investment Strategy at ProShares. We're talking about dividend growth ETFs and high-income ETFs today. Kieran, welcome back. Great to have you on the show again.
Thanks, Neena. It's great to be with you. Always enjoy our conversations.
So dividend-paying stocks have been out of favor with investors lately, mainly because most investors piled into those mega cap growth stocks, particularly technology, particularly those in the technology sector. And those stocks generally tend to reinvest their profits for future expansion rather than paying dividends. Now, that situation has been changing. We'll talk a little bit about technology dividend payers later. But traditionally, dividend payers are from more mature companies in old economy sectors. So that is one reason why these stocks were out of favor, because we know that those sectors had underperformed and have been underperforming technology sector over the past few years. And then high interest rates. So dividend paying stocks have been facing a lot of competition from money market funds in particular. Money market funds have taken in more than $1 trillion over the past year or so. So many income-seeking investors, they now prefer money market funds for their income needs. So I wanted to start with your thoughts on the recent underperformance of dividend-paying stocks, particularly Dividend Aristocrats. And I saw an excellent note on ProShares website about these dividend aristocrats trading at a discount to the broader index. And there were they compared it with some historical averages. So could you walk us through how the current valuation looks relative to historical averages that you have seen?
Sure, Neena. So at ProShares, our view is that high-quality stocks like the Dividend Aristocrats that have continuously grown their dividends over the years are on sale, and that now is the time to be leaning in rather than running away from the sale, as the saying goes. So some of the reason for this is fundamental, and would love to dig into more of that later. But to just focus on valuations for a moment, you prompted a good discussion here on valuations. If you look at the S&P 500, currently trading at somewhere between 23 and 24 times earnings on a trailing basis. Any way you look at that, it's a little bit on the expensive side, either relative to its long-term average or relative to the relationship with interest rates. When we look at the S&P 500 Dividend Aristocrats, they're trading at roughly 19 times earnings, which is about where they've traded as far back as we track the data. So roughly in line with their historical averages, but maybe more importantly, relative to the S&P 500, their current multiple represents a discount of, let's call it 18%. In other words, the aristocrats are trading at roughly 82% of the valuation of the S&P 500. Now, why is that important? I'll give you two reasons. Number one, it's a rare occurrence that they trade at such discounts. And number two, history tells us that that discount has historically been a reliable buy signal. So when you kind of look at the long-term relationship of high quality stocks relative to broad market valuations, typically investors put a premium on those high quality stocks, including the aristocrats. But today's levels are a little bit unique, like we talked about, not unprecedented. We've seen these levels and even some cheaper valuations in the past, perhaps most notably in the prior to the great financial crisis. So in that 2007, 2008 period, which one could argue has some similarity to today's markets, the aristocrats were fairly cheap relative to the broad market. But if you look at those periods in the past and then look to see what performance of the aristocrats, of these high quality dividend growth stocks, was on a go forward basis, the data shows roughly a 4% annualized outperformance in 3 and 5 year periods. So again, that's the buy signal we're speaking about. And maybe even more interesting, Nina, outside of the large cap space, perhaps there's a bigger opportunity from a valuation perspective in small and mid cap stocks and even the technology aristocrats. Now, lots of folks have been speaking about discounted valuations in small and mid. That really isn't new. But this idea of a segment of technology dividend growth stocks that are also on sale is a little bit unique. And again, that's something we can talk about a little bit later. But the trick with all this valuation discussion, from our perspective, one needs to be patient. That's not easy in a market like we have today. But valuations in and of themselves aren't necessarily a catalyst. So one has to be patient over the longer term. Valuation has a very good predictive power on future returns. It just sometimes takes a while. And I feel like that's the kind of market we're in now.
Very interesting. Now, you mentioned Dividend Aristocrats. Now, these are very high quality companies that have been increasing their dividends for 25 years or more. So now let's take a step back and talk a little bit about two approaches to dividend investing. So there are dividend growth stocks and high dividend stocks. I personally like dividend growth stocks, particularly for longer term investing, because these are usually high quality companies with very solid balance sheets and stable cash flows. That is why they have been increasing their dividends for decades. But I was interested in your thoughts on the investment case for dividend growing stocks in the current market environment and over the long term in general.
Yeah, it's an interesting question, Nina, because you set it up in your earlier question. The dividend stocks, and in our particular case, dividend growth stocks, have been a bit unloved, shall we say, over the last year and a half, 2 years. There's been so much of the market's attention focused on the growth narrative, and in particular, this potential transformational impact of AI. And of course, there's competition from money market funds that are delivering seemingly risk-free yields that are finally attractive after a long period of time. But the thinking coming into 2024 was that the market had to broaden out from 2023's levels, because leadership in 2023 was very narrow. So I think the stat goes something like the top 10 stocks in the market, in the S&P 500 last year, delivered almost 70% of the S&P 500's returns. And most of those were AI-related names. You know the names by now, companies like NVIDIA and Microsoft and Broadcom, very good performers. So again, we were thinking kind of coming into the market that, well, in order for the market to advance from here, what needs to happen? Participation needs to move higher. There are some good fundamental characteristics here of the market, but we need wider participation. What has happened thus far through April? Well, kind of the opposite of what we thought, because this idea of concentration has gotten even more extreme. So again, if you look at what's really driving the 6% or so returns of the S&P 500 so far this year, those top 10 stocks, 8 of which are the same as last year's top 10 contributors, are now delivering over 83% of the market's return. So it's this idea of concentration. But look, trends come and trends go over the years. We've kind of seen this playbook carry out before. Not to say that AI and the potential of those stocks can do amazing things for efficiency and all their great potential, but to look at it kind of from a wider perspective, I think is very important. And our view is that investing in high quality stocks that have grown their dividends over the years is really a timeless strategy to create wealth. The long-term performance of the Dividend Aristocrats has been stellar. We wrote a piece recently and kind of looked at if you invested a hypothetical $1 million, for example, in the S&P 500 Dividend Aristocrats in May 2005, when they became an index of a group of companies that one could invest in, that $1 million investment would have turned into over $6.6 million by the end of 2023. That's an amount far greater than what the S&P 500 produced over that same time period. And remember, that really wasn't a very opportune time to be investing because, of course, you had the big drawdown from the great financial crisis just a few short years later. But in spite of that challenge, again, investing in high quality stocks that continue to grow their dividends year in, year out, it's a difficult thing to do. You got to have certain business characteristics like moatiness, like sustainable and durable competitive advantages. And these companies typically are run by management teams that are interested in returning capital to shareholders. So this idea of a growing income coupled with fantastic capital appreciation opportunity, you combine that together, it really makes for a timeless investment strategy. Now, when you think about kind of the current environment, I go back to that narrowness of the market leadership. What that tells us, and some of those names at the top of the market, by the way, have in fact been delivering very good and healthy earnings. So some of that, and even arguably a lot of that price appreciation has been justified. But there is an intense, in our view, focus now on earnings, because earnings is going to be the thing that is likely to drive stock market performance here for the remainder of 2024. And historically, the aristocrats have been able to deliver more consistent earnings than the broad market. So you take that fact, their long-term ability to deliver wealth, the fact that we think they're better positioned to deliver more solid earnings growth, the favorable valuations that we spoke about earlier, and this idea of an equal weighted approach, right? In a period of time when market cap weighted strategies may be a little bit concentrated and top heavy, we think we've got a great opportunity across the cap spectrum with the Dividend Aristocrat strategies.
Could you talk a little bit about your S&P 500 Dividend Aristocrats ETF? The ticker symbol is NOBL. What is the investment objective and what kind of exposure it is currently providing?
So NOBL, as you mentioned, Nina, is our flagship ETF. We have the market's largest lineup of dividend growth ETFs. It's anchored there by NOBL. NOBL invests exclusively in only 67 companies right now that have been able to achieve that rare feat of growing their dividends for at least 25 consecutive years. Now, the portfolio on average has grown their dividends for 40 consecutive years. And while these may not be the very sexy names associated with some of the growthiest parts of the market, like artificial intelligence that we just spoke about, they are high quality businesses run by management teams that are interested and devoted towards returning some of that capital to shareholders. Pretty well diversified across the 11 S&P sectors. And we found over the years that by utilizing a simple but very difficult to achieve dividend growth record over time, what you are getting is a collection of high quality names that by and large are well positioned to outperform the market. And that's what the data has shown over the years. One of the things that I will say differentiates the ProShares suite of dividend growth ETFs is that we apply the same philosophy to other parts of the market. So right alongside NOBL is our mid-cap dividend growth product that goes by the ticker of REGL. And that, similar to NOBL, invests in companies from the S&P 400 mid-cap index that have grown their dividends for at least 15 consecutive years. We round out our domestic suite with our small cap strategy, SMBV, and even our technology Dividend Aristocrats story, which is another very exciting part of the dividend story. That product's ticker is TDIV. So you have a really comprehensive suite to invest in high quality stocks that we think are uniquely positioned to do well in this environment. You can do that across the cap spectrum.
Let's talk a little bit more about the Technology Dividend Aristocrat ETF. And you mentioned diversification benefits and the likely broadening of the rally. But there are many investors who are interested in investing in these technology stocks to get the growth benefits. And at the same time, they are interested in some income, some dividend income as well. And I mentioned earlier, many technology companies, growth companies, do not pay a dividend, but many mature technology companies have been paying a dividend. In fact, Microsoft has been paying a dividend since 2003. Apple had started paying dividends in 1987. They discontinued that and then they resumed paying dividends in 2012. And many investors may not know, but NVIDIA also pays a dividend. It's a minuscule dividend, but they have been paying a dividend since 2012. So there is an investment case for technology sector dividend payers as well. And recently, two mega cap technology companies, technically they are not in the technology sector. They are a part of communication services sector as per GICS. So Facebook started paying its dividend. Facebook announced its first dividend last quarter, and Google just recently announced its first ever dividend. So these companies are maturing, and now they are generating so much cash that they can invest. They can invest in AI. They can invest in their data centers. They can also buy back shares, and they can also pay a dividend. So there is an investment case for these big mega cap tech players who are now paying a dividend. Could you talk about the investment case for tech sector dividend payers and dividend aristocrats?
Yeah, you bring up so many good points there, Nina. And I personally feel the technology sector, of course, everybody loves tech stocks right now, but from a dividend point of view, it's particularly interesting for all those reasons that you mentioned. And even today, after some of these large, everybody owns Alphabet, right? And they made news last week when they announced that they were incepting their first dividend. The stock, of course, had a very positive reaction. Some of that was earnings, but I think more and more people are realizing that technology is a prime opportunity to go dividend hunting, because the world of technology has evolved from this high growth, no profit kind of monolith of a sector from years ago where capital wasn't readily as returned to shareholder into this mature sector now that is high quality because they've got great balance sheets. They tend to carry low levels of debt, and they are producing prodigious amounts of free cash flow. A lot of that's going back to buybacks, but more than ever before, as you mentioned, some of that is going into a growing dividend stream. And those are the names that we want to own. So you mentioned a name like Microsoft. That is a name in our TDV portfolio. It's one of the not only longest tenure dividend growers in the tech space, but it's one of the biggest dividend players on the planet, period. So a fantastic name. The IT sector is not only one of the largest sources for the market's dividends now, but IT stocks have also grown their dividends at the fastest rate of any sector over the last 10 years or so. So again, that's a lot of the ingredients that we as dividend growth investors get very excited by. So when we think about why the case for technology and technology dividend growth stocks, those kind of reasons that I just mentioned were the main reasons why we launched TDV, the Technology Dividend Aristocrats, back in 2019. So when you kind of think about, well, what does that mean for today's markets, right, in the technology space? Fundamentally, there's a whole lot to like about technology. Of course, if you look at kind of it from a revenue growth perspective, the IT sector has the fastest level of projected revenue growth for 2024 as compared to any sector. They also have the highest margins, So you put those two dynamics together, that equals a whole lot of profits and free cash flow. Now, if there's a reason to be a little bit concerned with technology, I'll give you two. Number one is concentration risk, and number two is valuations, right? So when I think about the concentration risk, if you're owning some sort of technology exposure in a market cap weighted sector, chances are you're very, very heavily concentrated to a handful of names. Microsoft, Apple, NVIDIA, in a market cap weighted structure probably represent 50 to 60% of the tech sector. From a valuation perspective, lots of growth there, of course, but be careful of what you are paying for that growth, right? It's back to that earnings equation. Can they deliver on that earnings growth? What we do with TDV is we only want to own those technology-based names that have grown their dividends for at least 7 consecutive years. The way we put those into our portfolio is a little bit unique. We hold them on an equally weighted basis. So that allows us to own the highest quality technology names. Some of them aren't trading for these very rich multiples. So when you look at it at a portfolio basis, TDV right now is trading at a 22 times multiple, which is a whole lot cheaper than the IT sector, which is trading at well over a 30 times multiple on earnings, even cheaper than the S&P 500. So this combination of fast dividend growth, very high quality technology names that are earning lots of free cash flows and returning that in the form of growing dividends to investors. You put that in an equally weighted approach like TDV, and you really got an opportunity there to add some high quality growth at reasonable multiples in an expensive market. And again, that sounds like a very good opportunity for us here in this type of expensive, concentrated market.
Yeah, very interesting approach. Now let's move on to high income ETFs. And I mentioned earlier that dividend paying stocks have been out of favor with investors and dividend focused ETFs too. In fact, last year, dividend focused ETFs took in just about $1.5 billion. And that was one of the lowest on record. That is according to Bloomberg. And covered call ETFs that use option strategies to generate exceptionally high yields have been immensely popular with investors over the past couple of years or so. So last year, the investors poured more than $20 billion into these ETFs. That is also according to Bloomberg data. And so I wanted to talk about this rising popularity of these covered call ETFs. So in general, in addition to very high yields, very juicy yields, these strategies do reduce portfolio volatility to a certain extent. But investors should remember that there is no free lunch in investing. So these strategies would work best in sideways market, but they underperform in very strong bull markets. They do provide some protection when stocks fall. So 2022, which was brutal for stocks, during that year, these covered call strategies fell less than the broader indexes. But then after that, the stocks rebounded very strongly. Last year was a great year for stocks. So when stocks had a very impressive rally, and this year they continue to rally, these funds have been lagging their benchmarks. So could you talk about the rising popularity of these option-based income ETFs? And then I also wanted to talk about two new ETFs that you launched, which are also high income ETFs using options, but they follow slightly different methodology. So could you also explain how your ETFs are different from traditional option-based ETFs?
So fantastic lead in there, Nina. We travel the country frequently and speak with many types of investors, all the way from very sophisticated institutional-like investors, individual advisors, of course, all the way to the individual investor, the retail investor. And the topic we hear most frequently is the need for income, right? And generally speaking, that conversation is a simple one: the higher, the better. And as is often the case, the ETF industry has developed a number of solutions in order to deliver higher levels of yield that investors have been demanding. As you mentioned, this pocket of covered call strategies has really struck a chord with investors, and many billions of dollars have flowed into those products. The premise for those covered call strategies is attractive. You can earn a high level of income, as you mentioned, and get some level of equity participation. But here's the critical part of the story that we feel many investors are missing. Traditional covered call strategies involve that costly trade-off that you referenced. So in exchange for high levels of yield, investors are sacrificing, they're forfeiting some upside. That upside, it turns out, is quite substantial. You mentioned the 2023 market. The S&P, of course, returned over 26%. Traditional covered call strategies, and we benchmark those by utilizing the SIBO S&P 500 buy right strategy as a proxy. They returned only 12% in that market, so less than half of what the market delivered. Over time, that index has only delivered about 50 to 60% of the total returns of the S&P 500. At ProShares, we think we can deliver a better trade-off and have created solutions that deliver the high yields that investors are looking for, but also targeting the longer-term return potential for market benchmarks like the S&P 500 or the NASDAQ 100 over time. And we think that those strategies can capture the returns that the traditional covered call strategies are sacrificing or have sacrificed in the past. And so that, Nina, was kind of the impetus for us to launch our two newest products here at ProShares, which are in our high income suite of products, ISPY and IQQQ. So to dig into those strategies a little bit, most of the covered call strategies on the market today are what we call traditional. I've used that term a few times. It's probably worth defining, meaning those are strategies that utilize options that expire on a monthly basis. We brought ISPY, it's the ProShares S&P 500 high income ETF, to market back in December of last year as the first ETF to be powered by a daily option writing strategy. And we followed that up this year with IQQQ, which is based on the NASDAQ 100 index. That launched in March of this year. The strategies are fairly straightforward. For example, ISPY owns all the stocks of the S&P 500 and then writes out-of-the-money call options that expire on a daily basis. IQQQ does the same thing, except utilizing NASDAQ 100 stocks. Now, this approach brings a couple of unique and distinct benefits to investors. First, a daily call option strategy can generate high levels of yield that investors have been clamoring for. ISPY, it distributes income on a monthly basis, will make its next distribution in the middle of next week, and the amount it will be paying annualizes out at roughly 10.5%. That's far in excess, of course, of what you can earn by just investing in, say, a high dividend yielding strategy, and of course, probably multiples of what you get from a simple index like the S&P 500. So a very high level of income. But secondly, because the strategy utilizes a daily call writing strategy, ISPY can potentially participate in more of the underlying asset appreciations as markets move higher, capture the returns that those traditional strategies sacrifice. So far, that's exactly what ISPY has delivered. So if you look at the index that ISPY is tracking, it launched back in October of 2023. That's a period of time that's been pretty good for equity markets. The S&P has delivered about 19% in total returns. That traditional covered call index that I referenced earlier, the SIBO S&P 500 Buy Ride Index, that's only returned 9.5%. So again, leaving a lot of return on the table. When we look at ISPY's index, it returned 16.5% over that period. So gave you the high levels of income and then gave you about 86% of the S&P 500 returns. That's the innovation here. That's the benefit that we think investors are going to look to add to their portfolios to really improve that income and total return trade-off that we mentioned earlier. So very excited about this suite of products.
Very interesting approach, Kieran. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Thanks very much, Nina. Always great to be with you.
That was Kieran Kerwin of ProShares. Now let's recap the ETF tickers that we discussed and talk about some more ETFs. So the S&P 500 Dividend Aristocrats ETF is NOBL, NOBL. For mid-caps, the S&P Mid-Cap 400 Dividend Aristocrats ETF is REGL, ticker symbol is REGL. Now for large cap dividend growth ETFs, there are two more ETFs that I like. The most popular dividend growth ETF is by Vanguard. It is the Vanguard Dividend Appreciation ETF. The ticker symbol is VIG, and iShares offers a core dividend growth ETF. The ticker symbol is DGRO. Both these ETFs, as well as NOBL, they all hold very high quality companies that have been growing their dividends for many, many years. Now for technology, we talked about TDIV, the S&P Technology Dividend Aristocrat ETF. This holds tech companies that have consistently increased their dividends for at least 7 years. For technology dividends, First Trust also offers an ETF. The ticker symbol there is TDIV, TDIV. This invests in 100 companies, technology or telecommunications companies, and then all those holdings are dividend weighted. And then for high income options based strategies, he talked about 2 new ETFs. The ticker symbols there are ISPY and IQQQ. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.